In this country, the United States of America, we are taught to believe that if the stock market is doing well, our entire economy is doing well. And the stock market has been doing incredibly well for the last 40 years. But if you add up all of the goods and services bought and sold in the United States, which of course is the actual economy, that number is not growing nearly as quickly as the stock market is. Wages are pretty much stagnant, and the average family's net worth hasn't really recovered all that well since the Great Recession. So that begs the question, what is the stock market measuring? To make it easy, let's assume that for Christmas time, there is a little girl selling hot chocolate outside of her house to the rest of the neighborhood. If that hot cocoa stand can't get a loan from the bank, meaning they can't get financing to buy milk, cocoa powder, plastic cups, and whipped cream, or whatever it is they're using to make the hot cocoa, they could instead offer to sell stocks of that hot chocolate stand to rich investors. That of course is called an IPO, or initial public offer. Investors will pay a small amount, say $1, to own one share in this hot cocoa stand. So if the children of this neighborhood sell a bunch of shares in their hot cocoa business, then they can grow their hot cocoa empire. So now the children running this hot cocoa stand, they can take the money from investors and in return give their investors stock in the company. With that money, they can set up many other hot cocoa stands or even branch out and sell other products like hot cider or s'mores. Now by expanding their hot cocoa business, they can take some of that extra profit and they can return it to their investors. That of course is called a dividend. Now the reason this hot cocoa stand might pay investors dividends is that gets investors excited and it entices them to buy more stock. So now let's say you have an old man in the neighborhood who is sick with the coronavirus on IPO day, so he was not able to go out and buy stock of the hot cocoa business. But he thinks this family is really onto something, he thinks they're going to make it big, and he still sees a way to profit. So this old man might go to one of the original investors and offer to pay $2 for that share in the hot cocoa business, even though the original investor only paid $1 for that same share. In other words, the old man who missed out on IPO day, he might be willing to pay double what the first guy paid, if and only if he's thinking to himself that later on down the line, he will be able to sell his $2 share for $4, $6, or $8, or some factor greater than what he bought it for. In essence, that is what the stock market is. It is people buying pieces of companies thinking that later on, somebody else will be willing to spend more for that same piece of the company. Now, of course, in real life, it is much more complicated than our hot cocoa business because this is happening thousands of times every single second all over the world. So today, many of the world's biggest companies are publicly traded on the stock market. This is because companies discovered the same thing that our make-believe family with the cocoa stand discovered. If you allow the public to buy shares of your business, you can grow exponentially faster. Now, this can be a double-edged sword. On the one hand, it entices companies to do really well because the better a company does, the bigger dividends it can give back to its shareholders, and of course that would encourage more people to buy and invest in their company. It also has the opportunity to create massive inequality because people who are good at playing the stock market can make themselves a fortune. Warren Buffett is arguably the greatest investor of all time, and even he says that for the average person, just put your money in the S&P 500 index fund, and most of you guys watching know that that's exactly what I do. The problem is, it isn't necessarily the real value of those companies that drive up the stock prices, it's the perceived value of the companies that drive up the stock prices. Now, sometimes the stories that can inflate or deflate a stock can be backed by facts, and other times they can just be all hype. And of course, when stock market bubbles burst, it can wreak havoc on the entire economy. Companies can go under, millions of people can lose their jobs. It can be incredibly tragic to the society when the stock market tanks. Where this gets dangerous is that because companies are owned by the shareholders, the now sole objective of those companies is to make a profit. In fact, there's a lot of statistics about how CEOs make 300 times what the average employee makes, and that is because for many publicly traded companies, the CEO's pay is directly tied to the share price. So if the share price of the stock goes up 80%, that means that CEO is going to get a huge bonus. So it is in the CEO's best interest to do whatever he or she can do to make sure that stock price remains high. One way to artificially increase the stock price is to actually buy back a lot of your own shares, which limits the supply and of course means that every individual stock is now worth more. In fact, between the years of 2007 and 2016, companies in the S&P 500 spent 55% of their annual budget buying back their own stock. In that same time frame, they also spent about 40% of their budget in dividends, meaning giving money back to their own shareholders, which of course didn't leave a whole lot of room for salary increases for their employees. Laying off employees, cutting costs, and basically reducing as much expenditure as possible, those are all things that can help the price of a stock increase, but they're bad for the economy overall. Unfortunately, what the stock market cares about is short-term profits, not necessarily long-term sustainable economic growth. I'm guilty of this too. As an investor, I'm always looking looking at how much money can I make and how quickly can I make it. That allows for a small handful of people to profit, leaving the rest of the country with stagnating wages. So it's no surprise that as the stock market has gone up in the United States, so has inequality. The middle class isn't even really investing anymore. Only a few people at the top are reaping all the rewards of the stock market. But it doesn't have to be this way. The stock market allows the public to decide which companies to invest in. It allows people like you and me to make decisions about what companies we think we want to gamble on and what companies we feel aren't worth the risk. Stockholders can influence how a company behaves and what interests they take into account. But that is pretty much it for this video, you guys. That is a basic introduction to the stock market. I hope you found value in this video, and I'll see you at the next one. Peace.